Hello, hello, everyone. Welcome to another the Tape Report webinar. It's just past 2 o'clock, so I'm going to let everyone filter in, and then we will go ahead and get started talking about how to generate distributions with options. We picked an interesting market day for this. Looks like we're down about 1% right now on the S&P. Hey, John. A lot of familiar faces here. Nice to see everyone, or familiar names, I should say. Only you can see my face. Uh, but yeah, go ahead and just some housekeeping notes here to start off. If you have any questions throughout the webinar, please go ahead and post those in the question and answers section, and I'll be able to take a look at those. And I'll take them either in line if that's appropriate, or I'll also reserve some time at the end to go over any questions anyone has. As usual with these webinars, I try to keep them, once I get running talking about a bunch of stuff, it goes long, but my target is somewhere 30 to 40 minutes focused on specifically this element. We'll be doing these bi-weekly going forward. And for everyone that's here, you've obviously gotten an email from me about this, so you will continue to get those emails. And if you want to spread the love, just send them over to the tape.report/webinars where you can sign up and make sure that you get all the new and latest from me, Harvested Financial, and the Tape Report. Cool. So I'm going to go ahead and get started today. The focus of the webinar here is going to be generating distributions with options. So you've definitely heard me say this before. If I've ever said anything, it's that there are two big ways of thinking about options strategies. And we have our kind of long-term investment structures that are used for risk transfer, where we're accelerating or decelerating or buffering or accelerating the returns of an underlying index or stock. The other big bucket is that opportunity capture stuff. So if you're looking at the tape report, we have the strategy laboratory for the long-term stuff and the short-term edge screeners for finding those opportunities and for finding short-term mispricings, places where you're able to take more risk or in risk in different dimensions than the way the market is pricing, and that can be an edge or an opportunity. So in the previous webinar, we talked about overlays. If you haven't had a chance to see that, go ahead and take a look. That's both in the webinar library for clients, or you can check out Harvested Financial's YouTube channel, where they're also available. When we were talking about those overlays, those were generally about adjusting the performance, like I was saying, that we're either dialing up or down the specific risk. Whereas today, the strategy, generating those distributions, that's going to be about kind of turning that equity into cash. Uh, and as a reminder, this is why I always put this up at the front because I always forget about it. None of this webinar is financial advice. That is only able to happen under the terms of a contract. So this is not financial, tax, legal, any kind of advice, purely for educational purposes. Harvested Financial and myself are registered investment advisors, but we are not necessarily your investment advisors. So we'll get right into the problem with equities. Like I was saying, the goal of the distribution strategy is to solve this question of I own a bunch of stock, but I can't pay my bills with shares of stock. Equities are great for earning, but they're hard to spend. If you want to fund your life and your goals, you're going to need cash. Now, I might put an asterisk here that, of course, you can borrow against your equity and whatnot. But what this goal is about here is for taking a long-term position, a sort of fundamental investment type thesis position, and over time generating distributions. Now, distributions in excess of what that might already be doing otherwise, and taking that stock and converting it into something more useful. There are a couple different reasons why you might be doing that. The first might just be simple de-risking. that you either have a very concentrated position. Sometimes I see this with employee RSUs where they get stock in the company that they're working for. They tend to have a concentrated position. They don't want to hit the big sell button all at once. We want to de-risk that over time, reallocate that. Another sort of flavor of that, that maybe we're moving from a concentrated position into a diversified index. Maybe we're getting out of our index position because we want to start deploying capital elsewhere. Maybe it's a purchase of something. Maybe it's another investment. Generally moving the portfolio around. We're going to use these distribution strategies to take that stock position and convert it into cash. There's the general objective that you might be interested in generating some structured cash flow. So, kind of thinking about this like an annuity, that how can I take an equity position and make it behave a little bit more like an annuity, make it consistently pay a certain percentage over time. Finally, I put the question mark here on this last one for generating alpha. And I put the question mark because, I'm not totally sure that this is actually the best way to generate alpha. That this is more about altering the risk profile, the literal security type of what you're holding. It's generally, most flavors of this are not necessarily going to outperform the underlying equity. They might outperform other benchmarks or whatnot, but the goal here isn't to kind of do better with Apple or do better with SPY. It's about converting that. So rarely, given a kind of objective of generating distributions, are you actually going to be able to outperform the underlying? But that's not the point. You're, like we said, getting out of concentrated positions, reallocating, or just prefer that structured cash flow as a retiree that's looking for, monthly cash to pay the bills. So, given kind of those objectives, and I hinted at it before, but there are a couple different components to what the or where the distribution is going to be coming from. So, dividends, that if we're looking to generate X% a month, some piece of that is going to come from dividends. Generally this is going to be trying to achieve something that's distributing at a more frequent or higher rate than just pure dividends. But of course, when a company pays dividends, that will flow through as part of your kind of overall distribution in this strategy. Some of that distribution amount is cash is going to be coming from options premiums. So, as I'm sort of starting to hint at, a lot of this strategy is about selling calls, selling covered calls on equity at various ranges to generate additional distributions. So, in addition to the dividends that you get, you're going to get premiums from those options that you sell. Another component is going to be equity sold shares. If you're trying to divest out of a position, or if you're just trying to meet that monthly yield target, you're going to have to sell some of those shares over time. That the option premiums and dividends generally aren't enough to make up for some of the higher distribution rates that you might be looking to demand here. So over time, and that gets back to the alpha, you're selling some of these shares, so necessarily you're going to be underperforming. But that's not the point. This is about converting risk. The last item I have here, and I probably should have an asterisk on it, but interest. Depending on how fancy you want to get with this strategy, there is a dynamic where one could get synthetic deltas from, or a synthetic underlying position from puts and calls rather than actually owning the stock. So if that is the case, then often we'd put the balance of the account in something like treasury bills or it'd be earning interest in a brokerage account anyway. So there can be interest components to this if you start getting complicated by using options on options. But for the most part, we're going to think about this, and most of the back tests that I'll show you are based on just basic equity ownership. So interest really deserves an asterisk there in terms of the components. We're mostly talking about share sales, dividends, and options premiums that will make up that distribution. So, without further ado, I introduce you to Distro Yield. That is the brand name over at the tape for this distribution strategy. And it is a dynamic covered call strategy that adapts to the performance and path. So, starting out with this idea of wanting to generate a certain amount of a distribution every month. We might say our target is distributing 2% cash or 5% cash from a concentrated stock position that we have. To generate that 2% cash, it's going to depend on, of course, what delta you trade at, what call you're selling against that, but it's also going to matter what the stock does over time. So if you are selling the, say, 30 delta call out of the money and stock runs up, well, some of those shares are going to get sold and you kind of quickly hit your distribution target. So over time, you might adjust that delta. Um, with this strategy, we're looking at a monthly distribution structure, but we're selling calls weekly. So you sort of get four chances, call it within a month, that you're trying to reach both that premium target and overall distribution amount. So if you get hit early on, you might be less aggressive over time. If you're selling calls and you're not getting called away because the stock's going down or staying flat, you'll have some premium, so you'll be working towards your distribution that way, but you might have to get more aggressive and sell shares over time. So to achieve a sort of smooth distribution rate, this distro yield strategy will dynamically adjust to what has happened in the past and where you are in terms of cash flow relative to your target. So I mentioned adjusting delta to take care of that. But then the other kind of dimension that the strategy will adjust on is the percentage of your position. If you're looking to generate a certain sale or a certain premium or yield amount per month, you will only start by selling calls on a portion of that and get more aggressive over time to sell more calls if you're not getting called away, if you're not earning those premiums. So we have sort of two moving parts here with both delta and percentage overlays to hit that distribution target. And so when you initiate a distro yield strategy, it'll typically, there are a bunch of parameters that we'll get into in some of the back tests a little bit later. But over time, it'll keep track of all your history, all your distribution amounts, and continue to dynamically adjust. So double clicking a little bit more on delta here. There's sort of a couple different things about using a delta target that I think are interesting. The first is that delta takes into account implied volatility. So a good thing I like about distro yield or strategies in general is that when we're setting targets, we want to set them based on a delta level rather than a specific percentage out of the money or something like that. That by using delta, we take into account, hey, is this a high volatility environment where that X delta 30 delta call will be further away from the spot price than it is in a low volatility environment. So delta reacts to that implied volatility and sort of adjusts in its own right. Uh, Part of that, again, of course, is sort of the strike distance. So thinking about how far away we want to go, what kind of bounds do we want to do? Are we really aggressive and we have to get this kind of distribution moving along? Do we have a short timeline? We're going to be more aggressive on both that delta and ergo the strike distance. I hinted that the core way that we think about distro yield is doing weekly expirations with a monthly distribution target. Of course, this can be flexible, and you can think about it as monthly options sales against a quarterly distribution target. You could do weeklies against quarterly distributions. So thinking about where in that time space you want to be setting your strike targets is also interesting. Some names might not even have weekly options, so you wouldn't be able to do it weekly and monthly distributions. Moneyness, again, that it's back to some of that question about how aggressive you want to be. That in the money or at the money options, if you select those, you're of course much more likely to get exercise. You're going to be producing more significant distributions with more regularity. So all of these sort of dimensions of delta boil down to how aggressive and how consistent you want to be, and frankly, how active you want to be in trading it. So again, double clicking on the overlay percentage here. An element to this overlay percentage might be the urgency. That doing higher percentage overlays, of course, are going to get you out the door sooner. the adaptiveness of that overlay percentage throughout the cycle. You can set bounds. Do you ever want to actually be overwriting 100% of the position? Maybe not. Um, and an important component of that uh, percentage element is how big of a pie are you dealing with in the first place. So one thing that both the granularity and total size hint at is that low dollar stocks are a lot easier to do this for the same amount of capital. Because you get a lot more flexibility in terms of the percentage of shares that you might be selling at any given time. And I think that granularity and share number ends up being a little more valuable than, say, the granularity and delta that you would get at a very high dollar stock. In SPY or Apple, you have quite a few strike choices, much more than you would on a percentage or delta basis than a low dollar stock. But having those extra shares definitely gives a lot more flexibility with this. So, to the extent that you're thinking about this as a strategy where you are choosing a stock to then, kind of turn into a mini annuity, you would generally bias lower dollar stocks. For most material levels of capital, even that granularity really is kind of always working with you. So kind of a simulated example here of what we'd be doing over time. If this is over the course of a month, initially we would be, stocks running up. We probably got called away on some shares here. So the next time we're going to lower the delta. So if we got hit on our 30 delta call, boom, the next time we might adjust down to 10. On the flip side, as stocks going down, that's when and going away from our calls, uh, we're going to increase the percentage of shares that we're overwriting. That we want to kind of at each interval that we're adjusting, recalibrate for what's happened in the past, what is the path that this stock has gone down throughout the month or quarterly or whenever it happens. That underlying is going to get some dividends. We want to make sure to add those into the soup, adjusting our percentages based on how much cash is in the account, whether it's from dividends or share sales or options premium. And then finally, towards the end of the period, we would look at our overall results, adjust based on and adjust the underlying position based on how much or to meet that distribution target. So we might outwardly just sell shares that because for whatever reason we didn't get exercised or we didn't meet our distribution target from the other sources. So this is not financial advice, but this is absolutely not tax advice either. That is definitely something above my pay grade, and you should talk to an accountant to the extent that you want to start thinking about this. But some of the core considerations, and it's not complicated per se. It's just a couple moving parts. So if you haven't been able to tell already, this is definitely modeled on some of those ETFs that are out there. So the Yield Max suite of ETFs is a big one, but there are a number of different ETFs that are, explicitly set up with the target or with a target distribution rate in mind, and they do it by selling calls and shares and everything that we've talked about here. But one of the considerations about this is, and that's worth it considering from a tax perspective as well as kind of a fundamental strategy perspective, is that a lot of the money that is being put off in terms of distributions is really a return of capital. That not all of that distribution is generated from the dividends and the options premium component of this. That some of that is shares that you bought that you're now selling, whether they got called away or you're selling them outright. Some of that is just your capital going back to you. And when you own this in an ETF, they're actually very specific about that for the tax forms there. They will detail exactly what percent of your distribution is return of capital. It lowers your basis on the ETF. There are a couple tax considerations there. But for your own purposes, when running this independently, recognizing that fact that, yep, some of that distribution coming out of this is just your stock coming back to you in the form of cash, the stock that you initiated the strategy with. Other tax considerations, the options premium is, of course, short-term gains and losses. So something to think about there. Losses would come to the extent that you start buying back those calls. And maybe you overextended with a distribution and you don't actually want to have it sell shares. But generating those short-term gains and losses as well as long-term capital gains, depending on whether you initiated this equity and just bought shares, or this is a position that you've had for some period of time. Some of that is going to be at the long-term rate. And then, of course, because nothing's simple with taxes, we also have the dividend tax rate considerations. So, couple moving parts there. Each of the components of the distribution is going to get treated differently from a tax perspective. So, really important part of this, and this is true about distro yield, this is true about any covered call strategy, is what underlying stock are you picking here? That really, most of the, I get a lot of questions. Oh, what's the best delta call to sell, or what's the best expiration on the call? Really, I have some rules of thumb about 30 delta, 30 days, but really the underlying stock and the choice of underlying stock is one of the most important things. And distro yield as a covered call flavor is really no different. So, thinking about some of the stock selection criteria, these are certainly not comprehensive, but the way you'd want to think about any equity analysis. So thinking about stocks, the implied volatility, that names that have high implied volatility are of course going to have relatively rich options, and so the options premium amount is going to be more significant there. Of course, higher implied volatility also means you might see a lot of range to your underlying valuations just due to that higher implied volatility coming from somewhere. So implied vol kind of cuts both directions, but with any option strategy, something to be aware of. Maybe as a sub point to that, the volatility risk premium is interesting to consider here, of course, because any option selling strategy is going to be generally more successful to the extent that there is positive and material volatility risk premium there. That is the underlying moving less than the options are implying. Fundamentals. So generally, what is this company doing? How well are they doing it? How likely are they to continue along steadily, whether that's for paying the bills and paying the dividends, I should say, or whether that's generally just equity performance. So what's going on fundamentally with that underlying? Considering the distribution rate, obviously a component of that too, that to the extent that an equity is paying high dividends, that more will of course go towards your kind of distribution bucket. Generally, those names that are paying high dividends, though, are going to have much lower implied volatility, so you're not collecting as much from the options premium in those names. Overall share price, the trend, momentum, any kind of technical or fundamental indicator that you might want to consider in selecting a stock just to own or for a covered call is going to matter here. Combining all these together, I generally like things with moderate dividend rates, as high an implied vol as you can go, given that generally strong companies. I think it can work well whether you go for aggressive growth companies. Of course, then you're going to have a lot of, you're going to continue to have shares that you can sell over time. Positive performance is important, but then, steady performance is also important. So here's where I'll get in a little bit to what we can do with the tape report and how to think about distro yield within the tape report. So similar to skew prime and hedge roll, we have the same structure where start with a back test, analyze a couple of the different strategies, play with some of the knobs and parameters, and adjust that to something that looks like it would be favorable and reasonable for you, and then ultimately move on to subscribe to that strategy and get updates or actually have it traded for yourself. But as we start to think about back testing this, I have here kind of an example of all the different parameters that are going into it. So the sample is suggesting NVIDIA with a target yield of 5.5%. 5.5% is a lot of yield to expect on a monthly basis, right? So again, pointing to the idea that you are probably going to be selling some shares to achieve that. But that's, I think, an interesting component to play with as you experiment just how aggressive you want to get with that yield target. Of course, if NVIDIA is returning 80% a year, just in equity gains, then you're going to be, on track with that 5.5% a month. That's just not particularly common. So we want to think about what our target yield is, and that's going to kind of determine at each interval how many shares we sell, what percentage of our current share pool are we overwriting. Here we're starting with 10,000 shares. That would be a nice position to have in NVIDIA. Um, we come up with a starting delta. So where do we start selling? Say we don't sell any deltas below 5. We don't want to go above 80 either. We want to start by targeting from a distribution perspective, if 5.5% represents a certain number of shares, we might only write calls on half of that to begin with. That's what that 50% is saying. So after week 1 of 4, we get dinged on our call, half of our shares go away. We still have 3 weeks, 3 intervals to make up that target. So we might get less aggressive on the second week because we got hit on 50% the first time. But we don't want to necessarily, start by overwriting everything or get too aggressive. The goal with distro yield is to be adaptive and take what the market gives us. We think about the max overlay. We, of course, don't want to sell more than the 100% of our shares. Any cash buffer we can keep in there. And then the distribution cap element is about saying that, oops, we got dinged on our first 2 share sales. We have actually more than our 5% target. We would never distribute more than 1.5x our target. And that's to sort of prevent you from, the happenstance, the path of all your shares getting instantly called away. You don't want to reduce your position by more. You want to kind of keep that and carry it forward. So the results of the back test will look something like this. So this is a sample equity curve that I have here for distro yield. And you can see this is SPY over the last 10 years. And so I believe we started with something like 10,000 shares. That looks right. So in gray, we have what the S&P would have looked like. The benchmark is a buy and hold with a dividend reinvestment. So it tracks dividends. It's very much mimicking that kind of like passive allocation to the equity. The green line up top is the total return. And so one of the effects that I'll point out here is that it continues to flatline over time. And that's because you are more and more of your position is becoming cash. With a target distribution of, I think, 2.5% in this example, slowly you're converting more of that equity into cash. And I'll pull up the site in just a second. When you're actually in the report, you can see the share count over time. But if you start with 10,000, 10 years later, you only end up with 400 shares. So you're participating less and less over time. But all the way back to our objectives with this strategy, the goal is to produce cash and distributions to live on, to reallocate stock, or to move it from a concentrated position. So generally, this isn't the whole story here. The another way to represent that is this green line at the bottom, which is our active NAV. So you can see that over time, we start with a $2 million position 10 years ago. That position only is worth something like 400,000 at the end. So why don't I just pull it up? Oops. And we'll look at it there. So again, ways to illustrate the kind of what's going on with your position over time. So I'll turn that active nav back on here. Yeah, we start with 10,000 shares, $2 million worth of nav, but by the end, 10 years later, that SPY position is down to only 400 shares. So you've been selling your stock over time and converting it into something else, something more useful. This will show a little bit of detail on some of the monthly distributions and where they end up as. It'll break down over time what your premium collection was, what your dividends were, what percentage of that were capital gains, because ideally you're picking a stock that's going up and some of those shares are going to be worth more than when you originally bought them. and what percent is return on capital or return of capital. So the shares that were sold, how much were they, the cost basis basically. So yeah, this was targeting a 2.5% yield. We got 2.6% yield over time. But that $200,000 or sorry, $2 million position at the beginning here was generating on average about 26 grand a month. So that's, a nice distribution, of course. 2.5% a month is quite a chunk of change, but that is going down over time. So no surprise, with fewer shares, your average distribution is going to continue to shrink over time. These distributions are only 11,000 in the final year, whereas they were closer to 40 and 50,000 in the beginning. Just because you're giving away that stock, you're selling it, you're reallocating it. Uh, so Yep, here's a little bit more zoomed in example of kind of the components and looking at where those distributions were coming from. This is a shorter time frame, bigger position size. So, like all the reports that we have at the tape, sort of the process that we have is build a signal, back test, come up with the right strategy that's going to fit what your objectives are, how much you're looking to sell, how quickly you're looking to sell, get the context around that. Clients will get notifications on these trades, when to roll, how to adjust. If you set up an account with Harvested Financial, we will trade it for you. And over time, we're trying to convert stock into cash, convert stock into something useful that you can use. So I will now open it up for any questions that anyone has on the distro yield strategy and what we've got working here. Nope. All right. Well, no, thank you all for attending, to all the familiar names and faces. Nice to see you again. And this webinar will be available on the website, in the dashboard, and as well as on YouTube. So you'll get a notification when that goes out. And oh, yeah, here we got one question. So, can the back test show a consistent selling program instead of a buy and hold? Like if you're selling a 30 delta. Um, Interesting. So I think if I understand, and I'll reach out, Zeke, but I think maybe a benchmark might not necessarily be the underlying stock, but a kind of standard covered call as the benchmark there. Um, that's an interesting idea. I think that's always a question when you're kind of defining benchmarks, is what the right choice is. But I think there's a good argument that, maybe a covered call strategy would be interesting there. All right, cool. Well, no, again, thank you everyone for attending here. I appreciate it, and stay tuned for the replay of this. And any questions, you know where to find me. Happy trading all.